show on NDTV Profit, and I'm Mathew. This show gets you actionable insight so that you can get the most bang for your buck when it comes to mutual fund investments. We've got a few topics lined up for today. First, it's been a tough couple of days for HDFC Bank. In just the last 3 days, it has dropped over 10%. What does that mean for your mutual fund investments? Which schemes are currently overweight on the bank? And more importantly, what should you do? That's the first topic. Then we'll talk about what you should do if you've got a lump sum that you would like to deploy in the equity market. Should you invest in one go? Or should you stagger your investments over a period of time? What should that time frame be? And should you use the option called STP, which is a systematic transfer plan? And finally, there are two options when you're choosing a mutual fund scheme. One is growth and the other is dividend. If you're looking for a regular income from your mutual fund investments, should you choose the second option? That is the third question that we're asking today. We're joined by Kshitiz Mahajan, Managing Partner and Chief Executive Officer of Complete Circle Wealth Solutions, as well as Pankaj Mathpal, the Founder and Chief Executive Officer of Optima Money Managers. Thank you so much to the both of you for joining the show, and always a pleasure speaking with you. I will start by laying the context for the first conversation, which is which funds are overweight on HDFC Bank. Now, understandably, considering that it is over 10% of the benchmark Nifty 50, there is a large amount that is in all of the passively managed schemes. So all of the index funds, all of the ETFs have a lot of this. So you can't really do anything much about that. But which actively managed fund managers have gone overweight? I'll come to you first, Kshitiz. Which have you looked at which are overweight, and what is the percentage holding?
Good afternoon, Alex, and always a pleasure to be with you. And I think it's a very apt topic, a hot topic also. HDFC Bank, the way it's been corrected over the last 2 days. Having said that, you're right. Index funds have their weightage because it's a 14% construct of Nifty. But there are a lot of banking financial sector funds across mutual fund houses, whether it's Tata, ICICI, SBI, which focus on BFSI as a sector. Most of these BFSI sector funds, including Tata, ICICI, SBI, are close to about 14-15%, including Nippon also with HDFC Bank. There are a couple of large cap funds also, including SBI and Canara, which are close to about 10% in HDFC Bank. So there is no question mark I'm having on HDFC as a bank as a stock, but yes, just for the knowledge purpose, I'm just sharing with most of our viewers that it is a moment which normally happen because of the quarterly numbers which has come, and the third party income which has gone down, and there's a compression on margins. That's one of the reasons. But my overall view is that these funds on the large cap space has higher allocation, and nothing one can do right now about it. But yes, keep a close watch on what is happening in the markets. So BFSI funds, sectoral fund, which are banking oriented and financial service oriented, and a couple of these large cap funds. Else than your passively managed, as you said, funds are a little overweight on HDFC Bank as a company.
This is a good opportunity, I think, also to help understand portfolio constructions and the rule that governs this. Because you mentioned a few banking and financial services funds, those are thematic funds, as well as sectoral funds that have more than 10%. And of course, the passive strategies, which have more than 10%, because essentially they map the benchmark. Pankaj, there are rules that govern the maximum amount of allocation as percentage of AUM that actively managed funds can have. Can you explain how that works?
Yeah, definitely, Miss. As per SEBI regulation, there has to be a maximum allocation in one stock that is limited. And if we talk about a sectoral fund, there it can be equivalent to the that index has. So if you are talking about the BFSI theme-based index fund, so that index fund will have same as that index has. Or if you're talking about the actively, even not index fund, actively managed sectoral fund, it can also have equal to that index. But if you talk about other diversified funds like large cap, or mid cap, small cap in any diversified equity fund, there is also a limit that it cannot go beyond that 10% of that maximum 10% allocation can be in one stock. So that is a limit there. So if we see at this moment, see HDFC, one thing was there earlier because of merger, HDFC Bank and HDFC Limited, the allocation was higher than the permitted even. But then mutual fund houses, they tried to bring it down. But at this time also, as you mentioned earlier about the index fund are supposed to have allocation. If it is a index has the allocation, whatever it is, the index fund will have the similar allocation. But apart from large cap fund, there are a couple of other funds also, like flexi cap fund. If you see SDFC flexi cap fund or UTI focus fund, these funds also have allocation more than 9% as per the last disclosure. So, as you mentioned, always investors should diversify their portfolio. And when we say about the sectoral fund that you should have limited allocation in sector fund, this is the reason. It can be banking sector or it can be any other sector. When you have allocation in sectoral fund, the profit or loss may be more than the broader market. So one has to keep that in mind.
That's an important point to make. So Kshitiz, coming down to the advice, right? Because if we're talking about a bank, which is about 10% of allocation in the most aggressive or the most overweight portfolios, and if you're talking about a 10% drop over the last 2 or 3 days, the implication for the NAV is about 2% or 2.5% or thereabouts. It's not, it's not earth-shattering. It's not something to worry about too much. So from that perspective, what advice would you give to people if their fund is overweight on HDFC Bank?
Alex, sometimes not to act is the right act, if you ask me. So these are sharp movements which happen, news-based movements which happen. But look at a bank which is at 16,700 crore of net profit for a quarter. We are talking here about close to about 70,000 crore of profit on a yearly basis. We're talking about 1 year trading of 19, 1 year forward of 15, price to earning. And these multiples are reasonable multiples. They're not on an expensive side. So I don't see any problem in the long run. Yes, people who are looking at, yes, there can be opportunity. So just value that also, evaluate that also before investing into. My suggestion or what I would like to do here is to just hold on to these funds, and just keep on looking at an opportunity. If any further opportunity comes, maybe top it up with few funds rather than just thinking on. But yes, just don't look at parking into a sectoral fund because yes, a sectoral fund doesn't have a cap of 10%. It can go up to 20, 25% in a single stock also. So there are many IT funds where you have single stock of 23, 24% allocation also. But look at a diversified fund, not even large cap fund, because large cap fund find it difficult to beat index because of the regulation of 80% plus in top 100 stocks. Look at a diversified fund where you can get an allocation and no need to act on because HDFC Bank is getting hammered because of the quarterly numbers, some part of the quarterly numbers not in line. So there is no need to act. Just hold on and keep on sticking with your ships and STPs.
Okay. So I know that both of you all have spoken about the risks involved with sector funds or thematic funds. But having said that, there is a set of investors that is relatively familiar with the underlying and how the banking sector moves, and perhaps also has a longer term time frame going into a few years. They're convinced, and I know that Kshitiz, you've spoken about this in the past as well, the India growth story cannot happen without banks, and in that case you have large banks like HDFC Bank that have to participate. So if they want to, in that sense, time the market, I'm not saying that it's exactly timing, because I'm saying here the horizon is more. Can they look at this as a strategic opportunity to buy into a few sectoral funds? Kshitiz, this one's for you.
Yeah, Alex, so I'm with you. In fact, if you see BFSI as a sector, last 1 year has not done that well. So most of the biggies or maybe, heavyweights of BFSI, including Kotak, HDFC, SBI, ICICI, Axis, they haven't moved the way other stocks have moved. So yes, there is a clear-cut opportunity which is there on the sector. And you see, if, as I said earlier also, for nominal GDP, we are expecting a 12-13%. You can expect the BFSI sector to grow at 15-16% rate. So yes, there is an opportunity for people who understand the risk involved in a sectoral fund, who understand what fund they are getting into, and who has long-term view on the fund. They can look at this as an opportunity. But yes, do your due diligence. I am with you that yes, most of the banking stocks, they are actually trading maybe at a good valuations. And many of the small and mid-cap companies also, banks also, are now started doing well. So yes, there can be opportunity if you ask me.
All right. We have to slip into a very quick break, but on the other side, we're talking about strategy in terms of deploying funds and also in terms of which distribution of income you would prefer or you should prefer. Be back very quickly. Do stay tuned. Welcome back. You're watching the Mutual Fund Show. We're in conversation with Kshitiz Mahajan as well as Pankaj Mathpal. We're talking about next what you should do if you've got a sizable amount of money that you need to deploy into the equity markets. Now, it happens quite often. Either an FD matures, or if you're lucky, you've gotten a bonus that you have to deploy, or you've got reimbursements for the entire year that you need to claim at once. Any one of those reasons would mean that you have to deploy a certain amount of money in the equity market. If you've heard of the concept of STP, then this one is especially for you. Pankaj, first, can we explain the concept of a systematic transfer plan? And is that the best way to deploy a lump sum? Or would you say that you just go ahead and deploy if you've got a long enough time horizon?
See, nobody can time the market. So if you have long investment horizon, you can invest that money at any point of time. Whenever you have money, you invest. And when you need money, you can withdraw. But the concept of STP, I'll explain that. See, if you invest today the lump sum amount that tomorrow you're expecting some correction, then definitely you may feel bad that you invested yesterday. Why not wait it for 1 day, 2 days? So you can invest in staggered manner. Now, STP means you invest that money in lump sum in a low risk mutual fund, especially like a liquid fund or a short duration fund, and which is called a source fund. And then you set up STP. You decide that at what frequency, whether daily, weekly, fortnightly, monthly, whatever you decide, in which scheme the money should be transferred from that source scheme to the target scheme. And target scheme, because we are talking about the equity scheme. So if suppose you want to invest in any scheme of a fund house, in the same fund house, you will buy a liquid fund or a ultra short duration fund. You'll park that money, and then you decide which equity fund you want to transfer that money. And as I mentioned earlier, you can decide the frequency also. And systematically, that amount will keep on transferring from the debt fund to equity fund. Now, the thing is that for how long you should set up that STP. Sometimes what happens, investors feel that if the longer the duration, for example, you make it 6 months, 1 year, you keep transferring. But we have seen in past many times that if you decide for 6 months, you set up STP, means the whole amount will get transferred in 6 months. In 6 months, you are buying units at every time at the higher price because market is moving up. And after 6 months, once your whole amount is transferred from the debt to equity, and the market corrects. So nobody can time the market, but yes, as I mentioned, if you want to invest in staggered manner, you can have a time frame of something like 3 months, 4 months, something like this. But do not plan something like you transfer the money in a 6 month, 1 year, until unless you are sure that correction is expected very soon, and which is very difficult to predict.
Okay, that's
so,
a fair point.
This is the concept of STP, and one should plan like 2-3 months, you should transfer that money from that thing.
Okay, that's a fair point. Kshitiz, there are a lot of advisors that are pointing out, not necessarily in the mutual fund space, but at least on the stock side, they're saying that maybe it's a good idea to have a little bit of cash, and people are talking about between 15 and 20% at this juncture because of the kind of volatility we're seeing. This is not something that usually bothers a mutual fund investor because they're in it for the long term usually. But having said that, strategically, since we have this hypothetical scenario in which people have a large amount of money that they need to deploy, do you hold with the view that you should have a shorter term STP, 3 months or thereabouts, rather than a 6 month STP?
So, Alex, I am very much in line with what you are saying. I think you want to do 6 months, don't do STP. So, STP is meant to deploy your lump sum allocation and take, let's say, for example, if present scenarios where we have 3 days of correction, one should deploy 35% or 40% money at one go, and the remaining 60% you can do a STP for next, let's say, 6 to 8 weeks at the max. If some other scenario is there where market is volatile and you are not sure whether market will correct or go up or go down, then it's better to do 10 to 12 weeks on a higher side, 3 months STP. If there is a scenario when market is all-time high but valuations are reasonable, what we have seen in the last time that people are doing STP but lump sum has beaten. If you actually see journey from May 2022 onwards, in last 2 years, lump sum investment has beaten STP hands down because market was moving, like it's on a secular bull run, unidirectionally going up. But yes, if there is a scenario where markets are at high valuation and where markets are all-time high, then is the right time to do STP. In fact, we have done a we've done a calculation, just example per se. Let's say last previous high in 2021 was in November, and we did 6 months STP, and then we did lump sum investment. What we can make out is there is a difference of almost 4 to 5% in last 2 years in compounding in couple of funds where we have seen that yes, STP really works very well if you do 3 to 4 months STP or 6 months. Yes, people who think that it's this scenario is going to remain little long, but yes, my senses keep some powder dry, as you said in the beginning. There is some cash component which is always there on your side, irrespective of you are doing entire money for your equity allocation, because opportunities keeps on coming. Nobody would have thought of these 3 days. Many of the clients are saying, I'm saying this is the time one should buy. They say, but you should have money on the sideline to buy. So keep some powder dry, keep some money on the sideline, keep some money parked, and if required, maybe change some asset allocation if you have equity market giving these type of opportunities. Otherwise, also, Alex, if you see your goal planning, and if markets are falling like this, where you have a good allocation, you can deploy an equity market, you can change some asset allocation and put some money from debt to equity. But yes, these are very interesting times, and one should use this as an opportunity. I agree with your friends on the stock side also that you should have some powder dry and keep on looking for these type of opportunities where you can pick reasonable valuations, which is not a daily show.
Yeah, fair point. I think we should also remember that this is an election year, and
yes,
depending on the result, you could see a reaction in the stock market. So from that perspective, also 6 months is a bit of a long time to think about, right? Because a lot can change within that period. But having said that, let's also talk about the last aspect that I wanted to discuss today, which is the growth option and the dividend option. Now, the growth option is fairly simple to understand. Viewers, if you are investing in a mutual fund scheme with a growth option, essentially all of the profits that are earned by the underlying are redeployed within that scheme itself in the portfolio. In the dividend option, these are distributed to you on regular intervals, at regular periods of time. Now, I do want to understand first from Pankaj. Pankaj, in which situations would you use something like a dividend option? I would assume that this is when you want a regular income, right, from your mutual fund scheme. But is this the best option available?
Alex, first thing, let me clarify that dividend terminology has been changed to IDCW, means income distribution cum capital withdrawal. So there is a growth option and IDCW option, and which we are referring as a dividend. So when should one opt? When you want a regular cash flow, you're expecting that you want to book profit from time to time, you may opt for IDCW. But still, I will not suggest that because if you go for growth option, you have choice to withdraw either in lump sum or you can opt for SWP. Even if you want to manage your cash flow and you're expecting that the scheme will offer you regular dividend, regular IDCW, instead of that, you can opt for SWP. The benefit is when you opt for IDCW option or dividend option, that dividend is taxable at the slab rate applicable to the individual. So it means if you're in 30% bracket, you are paying 30% tax on the dividend payout. Whereas if you're withdrawing from the equity fund as a SWP or as a lump sum, in that case, we know that long term and short term is 15%, long term is 10%. So it makes better sense that you opt for growth option and then withdraw whenever you need money, or you opt for SWP.
Fair point. Kshitiz, I'm guessing that it's a very simple answer to this question, just purely on the basis of the post-tax return that you would get. That is the better option, right? SWP?
Yes, in fact, just to add to what Pankaj just said, I think SWP is much more tax efficient vis-a-vis not only dividend option, but vis-a-vis a normal withdrawal also, because it always works in a FIFO manner. First in, first out. So in SWP, you always withdraw some part of your investment. So some principal goes and some capital gain goes. So it actually doesn't work 10%. It works very little in the initial 3-4 years. It works 2-3% only when you withdraw. But eventually, the tax part in SWP is much more beneficial for a client vis-a-vis if you withdraw directly as a lump sum amount. So on an average in less than next 15-20 years, it's worked out to be 5.5-6% vis-a-vis 10% on overall withdrawal. Having said that, dividend option, yes, it's not tax efficient. For somebody who's having, income which is less than 5 lakh in old regime or 7 lakh in new regime, let's say, For them, I think that's much more tax efficient because there is no tax on any withdrawal, which is a part of that 7 lakh on overall gain of its income. So I think for people who are having less than 7 lakh income, dividend option is always a better option because there is no tax, as dividend is a part of now your taxable income.
Very important point there. We shouldn't just assume that everybody tuning into the show is at the 30% bracket. So those people that are within the lower brackets, and particularly I would think retired individuals that only need that much money to run their household or take care of their needs, will be in the lower tax brackets, and in fact the tax implications are lower. Kshitiz as well as Pankaj, thank you so much for joining in and for giving us the perspective that you did. And viewers, hopefully these issues that we've discussed today have been beneficial to you. If you've got anything to know about within the mutual fund space, you should write to us on the WhatsApp number. At some point we'll play that at the bottom of the screen. Do stay tuned, lots more coming up on NDTV Profit.
Nifty Sensex off day's lows. Sun Pharma, Tech M and Apollo Hospitals along with Axis Bank lead. Amid the market rebound, Nifty Pharma has emerged as the top gaining sector. Nifty Bank and Metals continue to trade in the red. Nifty mid-cap and small caps marginally trade in the red but outperform the benchmarks. HDFC Bank remains under the hammer. In the last 2 days, the ADRs have suffered a plunge of over 15%, while HDFC Bank stock has tanked nearly 10%. And more earnings on our radar today. IndusInd Bank, Polycab and Tata Communications are set to come out with their December quarter earnings. Hello and welcome. This is Last Trades. I'm Agam Vakil, and in this show we take you through all the bug deals, block deals and the big volume buzzers through the course of the day. But right at the top, let's start with the markets. Now, we have seen a little bit of recovery from the day's lows as far as the markets are concerned. And while the Bank Nifty did move in the green to a certain extent, it is once again showing a lot of weakness. So, well, there's some amount of weighing down as far as benchmarks are concerned. The Nifty, that has also come off from day's highs as well. Well, we're looking at a little bit of a range-bound session as far as benchmarks go. And it's been a quiet one at that. And there's been a little bit of a push and pull between, well, should I say bulls and bears at the moment. While we did see the Nifty once again make an attempt to move into the green, that really hasn't come through. And the question really is that if not today, then can we see a bout of short covering perhaps over the course of the next few days? And it is imminent, but when is something that we are yet to have an answer for. But as far as stocks go in terms of constituents, in terms of all the, well, should I say, the stocks which are perhaps pushing the Nifty higher would be something like an L&T, Axis Bank and Reliance Industries. On the other hand, HDFC Bank for yet another day continues to weigh heavily on that particular benchmark. And let's not forget, LTIM has come up with its earnings as well. We are seeing a sharp knock on that one as well, along with Asian Paints. So keep an eye on a whole host of these counters. Let's take a look at the broader markets too and what's really buzzing there. And we were talking